So, welcome once again to today's edition. Today, I'm going to look at the short-term decision-making techniques. One topic over there, but short-term decision-making techniques. But here, there are a lot of topics that we find here. We are going to list the critical ones. The critical ones are one, we have the CVP analysis. CVP or the break-even analysis is the champion. And last thing, no question came on that. So then from there we go to limiting factors. This one we've done it, so I'll just throw a little light on it. We did that one. It opposes the throughput. So the throughput that we did, the limiting factor opposes the throughput. For the limiting factor, we are just talking about contribution analysis. Throughput, you are talking about the throughput. So this is the difference. So whatever we did under the throughput is the same thing that we are going to do under the limiting factor. Good. So that is it. Then we have make or buy. Make or buy. Then we have shut down. Shut down. Then we'll look at pricing. That's the good news, pricing. So these are the issues that we have to look out for. But in order of importance, this last thing, there was a question on limiting factor. So that was last thing's question. Great. So last thing over here, one or combination of any other must drop compulsory. There must be question on this compulsory. So last sitting's on, they brought it from here. The previous sitting, a sitting before last sitting, they brought what? CVP. So have you seen how the game is? So it means that this time around, you can suggest this time around it will be between the CVP and then any of these three. You are done. So that is it. Good. So in fact, these three have handouts on this. So if I tackle this right now, I have to tackle this. But let me go to the CVP analysis so that we will finish the syllabus. As soon as I tackle this one, that means we are making a headway. So now you know what is ahead of us. All this must be done within this week. So I'll start with the very first one, the CVP. Good. I'll start with the CVP, and then you are fine. So that's the short-term decision-making techniques. 20 marks. From 20 marks of your syllabus out of the 100. CVP. Great. Right. Cost volume profit analysis. Cost volume profit analysis. It's also called break-even Break-even analysis. This is a topical issue that you should get it from me. Break-even analysis or cost volume profit analysis. By the time we finish today, you will know why they call it cost volume profit analysis. We explain why instead of the break-even, they are the same, no difference. Now, when you mention break-even, what comes to mind? You are breaking what? Even. Meaning no profit, no what? No loss. So over there, total revenue is equal to total cost. Or profit is equal to what? Zero. No profit, no loss. Good. Because profit is equal to what? Total revenue minus total cost. But when this and this, they are the same. Your total revenue and total cost the same. You are breaking even. Good. Now, I have also given this topic a nickname. I call it what? What if analysis. So, my name for this topic is what if analysis. So, I'll explain why I call it what if. Now, let's start the game. Let's assume that there is a company and then their selling price, the selling price of the company, SP, is nothing by 12 Ghana cedis. The selling price is 12 Ghana cedis. The variable cost is, let's say, 8 Ghana cedis. So who can tell me the contribution? What will be the contribution per unit? What will be the contribution per unit? So the contribution per unit will be what? 4 cedis, right? Because we said our contribution is nothing by the selling price less what? The variable cost. Good. Now, required. So if we ask you question like this, required, level 1 item, let me include it. The contribution is 4 cedis. If the fixed cost is, let's assume that it's 1,000. If the fixed cost for that company is just 1,000 Ghana cedis, that's their fixed cost. So now required. Now this is a question. Required. Determine the profit if the company produces the following units. 1. Determine the profit. In fact, if I say determine the profit, I'm asking to the question too fast. Prepare the operating statement if the company produces the following units. So prepare the operating statement. So prepare the operating statement. In management accounting, when we mention operating statement, we mean the profit or loss or the income statement. Great. If the company produce if the company produce 200 units, produce and sell. So sales and production units is 200, right? Sales and production is 200. Then B, the company produce 250 units. And finally, C, the company produces what? 350 units. Full stop. Start work. So with the help of what we did first, how are you going to determine the operating statement? Now that's the other section. I'll come to the explanation. of the topic. So let me just wipe this section well and then shift this one here so that we can good. I'll prepare them there. So fixed cost is equal to 1,000 Ghana. That's all, we are done. So the operating statement will be prepared as follows. Or will be this. So operating statement. Let me demarcate here. So operating statement. Yeah, they have given us 3 items. When the company produces and then sell 3 classes of the goods. So what do we do? What we have to do is this. Now when they produce 200, what will be the profit? Let me bring it here. 200, 250, and 350. So something like this. It starts. It says sales. What will be the total sales? Yeah, the total sales, we have to multiply each of the demand. For the demand, first one, demand is 200. So you multiply 200 by the selling price of 12 cities, and that will give us 200 by 12. That's 2,400. So that's 2,400. Agreed. Uh, yes, it's 2,400. Then it's a variable cost. Variable cost. Now, with the variable cost, what you have to do is just have to pick your calculator. The variable cost per unit is what? A series, right? So what to be the variable cost? To be the A series by the what they are selling, right? And that will give us 1,600, right? So therefore, the contribution will be 24 less 1,006. So that will give us 800, right? So they have a contribution of 800. Let's call it contribution. This is coming from marginal costing. So break even, CVP, we are using marginal costing. Take note. All our arrangements, our calculation that we are going to do under the break even is on assumption of what? Marginal costing. I hope you get it. Good. Then let's fixed cost. Let's take the fixed cost out. The fixed cost is 1,000 cities, right? So what will be the profit? So therefore, profit will be 200, right? They put in bracket because the contribution is lesser than what? The fixed cost. Good. That is it. Now, let's go to the 250. So 250 by 12 cities. That'll give us 3,000, eh? So 3,000, and then the variable cost 2,000, right? Good. And here will give us 1,000. Wow. So contribution here is 1,000, and then fixed cost also is what? 1,000. So what's the profit? Nil. Okay. Perfect. Then the next one. So 4,200, right? And then the variable cost will be 2,800. When you take it off, what do you get? So 1,400. Perfect. Then we still less what 1,000 cities from it. We still less 1,000 cities from it. And we had what 400 profit, right? In fact, we can do and then continue the game until you get tired. What are we in? Good. Now let's continue the game. Now you realize that at the various outputs or units, we determine what the profit. At the point in time, the profit was negative, so they made a loss. Then it became zero. Then they started positive, going. Great. Now, this unit 250, since that when you produce 250, you are making a profit of what? Zero. So this output or this unit is called break-even units. Now look at what we are doing. When they produce 200, what will be their total cost or their variable cost is 16. Okay, what's the contribution? It's 800. Okay, what is the fixed cost? It's 1000. Great. Then we come here. When they produce 250, when they produce 350 in that order, so what are we doing? We are doing what you call CVP, cost volume profit analysis. We are doing break-even analysis. So this, anytime you are analyzing changes in what outputs, its effect on what costs and profits and revenue, you are doing what you call CVP analysis. Great. Now, this volume in management accounting means outputs. So outputs or units. So how does changes in production unit affect your cost, affect your profit? That is what CVP analysis. So anytime that you are analyzing the effect of what changes in the outputs on the costs or the profits or the revenue, you are conducting what? CVP analysis. So that's why I gave it a nickname of what if analysis. What if you produce 200? What will be the impact on cost and the impact on profit? Now, what if we produce 250? What happened to our revenue, our costs, and then our what? Our profits. How we get it? What if we produce 350? What will be the impact? So that is it. So in short, now that we understand, or now that we've gotten the picture that CVP analysis just study how changes in the output affect what? Affect your profit and then your revenue and your what? Your cost, especially the variable cost. Good. How does changes in output affect it? So that's the CVP analysis. So you can put something down. Let's write some few definition of the CVP or the break-even analysis. So this analyze the effects on the effects on the profits, costs, and revenue with respect of changes in the outputs. So it analyze how changes in output affect one, revenue, two, cost, three, profits. We are done. So how changes in output affect what? Revenue, affect costs, and affect profits. So how changes in output or sales units, sales and production units affect what? Revenue, costs, and profit. Great. So that is the idea behind the CVP. So we are going to analyze into detail how changes in what the outputs affects revenue, costs, and profits. So anytime we are doing that, we are just conducting CVP test. So what if analysis? What if analysis? So it's like, what if I produce 10,000 units? What will be the effect on my cost, on my revenue? Okay, what if I reduce the production to, let's say, 8,000? What if I increase the production to 10,000? What will be the effect? Great. So that is it. Now let's see. Have you seen what we have done here? We were looking for the units that this company they must produce in order to break even. And upon calculation, this what we did here, it's a guesswork. For this one, the examiner himself did the guessing for us. I just guessed 200, 250, 350. And definitely one of them show up, give us 0. So it's happened to be what? The break-even unit. However, what if this one is not there? So you guess and guess and guess. So it means that there must be a shorthand or a formula for us to determine the break-even unit quickly. So let's see the formula. In fact, all the formulas you need to know, I have provided all of them in the handouts. So when you get a handout, kindly study the formula for me. Some part of break-even is a formula work, and then some part two is like decision making. It's a bit uh, dicey, but it's not difficult. Good. So let's see the formula. Now the formula we have for single unit, and then we have for what multiple units. So that is it. Like when you produce and sell 2 or more units, which of the formulas are you going to use? And if you produce just 1 unit, which of the formulas are you going to use? And then it ends there. Good. But before we go to the formulas, let's quickly put some of the assumptions of break-even down. Some of the assumptions of break-even. And then we will quickly calculate it for this question. So let's discuss the assumptions of what break-even analysis. You know, some of this break-even, we have to make some series of assumptions before break-even will work effectively. So there are assumptions that support the break-even. So assumptions. In fact, when the examiner asks you for limitation, write the same assumption for him and tell him that in reality, none of this assumption is true. So the same assumption is serving as what? As a limitation. Why? In reality, does not make sense, or that's not it's not true in reality. Good. So assumptions for break even. Assumptions for what? Break even. Or assumptions for CVP analysis. So assumption one, it assumes that production is equal to sales. So that's the first assumption. It assumes that production is equal to what? That's the production units is equal to sales units. Is equal to sales units. So in short, there's no closing inventory. That's what break even is saying. Is it in reality that the company will not keep some stock or some level of stock, in reality you will have what? Closing inventory. So this assumption will not hold in reality, because in reality they are what? Closing inventory, except for if the company is using what? Just in time. If the company is using just in time, that's good. So that's the first assumption. So when I ask you for limitation, just state that it assumes that production unit is equal to sales units. In reality, it's not true. In reality, businesses keep some level of inventory. Good. So that is it. Then assumption number two. Assumption number two. It's a pregnant assumption. So let me take my time and then break it down. Assumption two is a pregnant assumption. The first, in fact, is a double statement. It assumes that the company produces and sells only one product. So the company produces and sells only one product. So the company produces and sell only one product. So produce and sells only one word product, comma. So that's the first part. Second part, in a period or in a situation where the company produce multiple products, sales pattern remain constant. Sales pattern or sales mix remain constant. I like the mix. So in a period where the company produce what? Multiple products, multiple or multi products, multiple products, multiple products, sales mix remains constant. Sales what? Mix remain constant at all level of what? Period. Sales mix remain what? Constant at all level, at all level, or at all period, all level of activity or all period. So let's see. Let me take the first part. It assumes that the company produces and sells only one product. So here, break even, we assume that you only produce single products. So that's why we have the formula for single products and multiple products. So that's the first assumption. Well, it is not true. Companies have what? Multiple products. Take companies like Unilever, take NS Chemist, take most of the companies that we have in the country. They produce more than one what? Product. Even if you go to the market, the traditional marketing style, but they also produce or sells more than one product for convenience. Good. So that means that assumption will not hold in reality, right? Good. Then the second section, they say that in events where you produce and sell multiple products, the sales mix is what? Constant. So let us know that you produce three products. So example, maybe you produce um three items. So do I have good? Let's assume that you produce three. You produce tissue, bottled water, and marker. These are the three products that you produce. So tissue is here. Then the bottle I said tissue. The bottled water is here. Tissue too is here. Good. And then the marker, the three products. Now the sales mix is like this. Anytime you sell one bottle of the water, you have to sell maybe 2 packs of the tissue, and then it must move with 3 of the markers. That's the sales mix. So it's like you sell them together. So one of these, 2 of these, and one of the other products put together, then you dispatch them. So break even is assuming that anytime you are selling, that pattern is the same, does not change. Is it true? Now, will you tell the customer, let's assume that anytime you sell 1 bottle water, you have to sell what? 2 of what? The markers. Good. Face shield and sanitizer. So anytime that, and face masks and nose masks. Face masks, face shield, and sanitizer plus the tissue. Plus the tissue. In fact, here I going to sell them one, one, one. So all of them move together. So one face shield, one sanitizer, one nose mask, and then one tissue. They move together, right? Good. So that has been what the mix. So if a customer come and said, okay, me, I'm buying only sanitizer. No, I don't like those other stuff. I have them there. Will you sell to the person? You sell. So in reality, those mix will not work. In reality, you cannot always say that I'm selling all this as a complete pack. No. Because sometimes demand, what the customer wants what is what the customer will probably purchase from you, not what you want to sell to the customer, especially if you have a lot of products. So it means that the sales pattern cannot be the same. So it's not be always that all of them move together. So in reality, that statement is not true. So sometimes you change. Oh, formerly I was selling this more of this, but now it will reduce depending on the demand pattern. Then we go to the third assumption. Now, the third assumption states that it assumes that the selling price per unit and the variable cost remain constant over the periods. So, the selling price and what? The variable cost per unit remains what? Constant at all level of what? Activity or period. So the selling price per unit and the variable cost is constant at all level. That is the assumption number what? 3. So in reality, is it true that the selling price will be the same for quite a number of period? Not at all. The variable cost will be the same? Not at all. So that is it. Good. Then the fourth assumption says that you're on the third one. Eh. Okay, that's fine. Okay, so now let's go to the third one. But the third one is the selling price and the variable cost. Oh, that's the second one. Yes. Good. So the third one is the selling price and the variable cost remain constant at all levels of activity. That was the third point. The selling price and the variable cost per unit remains what? Constant at all level of activity. That is the assumption 3. That's the third assumption. That's the third assumption. Good. Now, assumption 4. It assumes that the fixed cost is the same or constant at all levels of what? Activity. So the fixed cost is what? Constant In reality, all of these they are not true. In reality, the fixed cost will not be fixed. It's only fixed for a relevant range of what outputs. So it also assumes that the fixed cost will be what? Will be fixed or constant at all level. So if your warehouse, the rent that you are paying is 24,000 every year, it's going to be 24,000 for the next periods ahead of you, which in reality might not be the case. So that's the fourth one. So the fourth one is about the fixed cost, right? And basically, we are talking about everything. Now let's go to the fifth one. The fifth one states that it assumes that cost can be classified only into what? Two. You can classify costs only into two. That is variable and what? Fixed. So according to CVP analysis, the cost of the organization can be grouped or classified into two. That is the variable costs and the fixed costs. In reality, it's not true. In reality, you can even have what you call step-up costs or semi-variable costs. Some costs, they are partly fixed and partly what? Variable. So all of them form parts. Good. So that is it. So these are the few assumptions that we have to put it back of mind. It's the same for the limitation. It's the same for the limitation. Good. It's the same for the limitation. Then your work for the day will be the importance or the benefits. Analyze the benefit of CVP analysis in today's manufacturing. Tell us the benefits of CVP analysis in today's what? Manufacturing. So analyze the benefit of CVP analysis. I wanted to add in today's manufacturing, but it's okay. Let me make it general so that we can get more to talk about. So that is it. Okay, now let's go to the formulas. Please, the formulas, make sure that you pay critical attention to them because sometimes they may help. Good. So first, the formula that we are going to derive is for a single product. So we are starting with break even for what? Single product. That means when a company produce only what? One unit. So only a unit, the formulas, and then we go to multiple products. When they produce two or more, that one you also have formulas for it. So the first thing that we are going to look at for is the break-even point. So, but I'm going to use formulas to produce these answers again, and you'll be fine. So the next thing I'll do is the break-even point. Break-even point. So first, single product. We are looking at the formulas for single product. When a company produces what? Single products. So the formula that we are going to use, but there are many, but I'll explain them stage by stage. Each of them have a purpose, so you should know the purpose. Great. Now, the first formula that we are going to look at for, let me number them. One, break-even point. Break-even point. Now, when you mention point on the x-axis or on the plane geometry, when you mention point, it means that there must be two coordinates, right? So if I point A, it means that when I trace here and I trace something like this, so the same way we are going to analyze it in break-even. So when I mention point, then they're asking for two items, the x coordinates and then the y coordinates. Don't worry. So break-even point, the two items are A, break-even point in units or break-even units. Break-even unit. So that is the unit that the company must produce in order to do what? Break even. So that's the break even what? Units. Great. So with the break even units, the formula is equal to, very nice, the fixed cost of the company divided by the contribution per unit. That is the break even units. So if the question asks you, determine the unit that they must produce in order to what? Break even. When they ask for units, that means they are just looking for a single aspect of the break-even point, which is what? Which is the fixed cost divided by the contribution per unit. Good. Now, fixed cost, they'll give it to you, contribution per unit, you know that is equal to selling price less what? Selling price less the variable cost, and then you are done. So the contribution that we started under the marginal cost approach. So for those of you who were with us under the marginal cost approach, in fact, you smile here. Or for those of you who have gone through that video, you also smile. But make sure that the initial or the intro parts, you get them, because the same thing I'm going to repeat again. So that is it. Then B. The B is break even value. Obviously, we have unit and then a value. So if they should produce this unit in order to break even, they want to be the sales value at that stage. So after production, what to be the sales value? Good. So therefore, that one, in fact, I'll give the first formula here. The subsequent studies, I'll bring the other ones to on board. So we call it break-even value or break-even sales revenue. Break-even sales revenue or break-even value. So in fact, the formula will be the break-even unit that we have determined here times what? The selling price. So that will be the first formula that we are going to use for now until future dates. So the answer will be the break-even unit times SP, the selling price. You are done. So for now, this is how we are going to do to determine the break-even unit and then the break-even what? Sales value. So now let's use it to solve the question. The one that we use the guessing to determine the unit that it should produce. So let's see. So let me produce that question again and let's see how best we can solve it. First, the selling price was SP, was 12 Ghana cedis. Variable cost is 8 cedis. Fixed cost is what? 1,000. So therefore, what is the break-even unit? Starts in work. So the break-even unit will be what? And what's the break-even value? So fixed cost divided by the contribution per unit. So therefore, here will be what? 1,000 Ghana cedis. That is the fixed cost divided by the contribution. For the first answer is in. I like that. Second one also is in. I like that. Okay. So here will be 12 less what 8, right? Or you can do it somewhere that the contribution will be what 4 cities. So the contribution is what 4 cities. So what you do is we divide. So if you've done the working somewhere, you place the contribution there. So that will be 4 cities. So let me just go straight forward. In fact, let me write everything full. 4 cedi per unit, right? So therefore, if every unit we are getting 4 cedi, then how many units are you going to produce? So cedi must cancel cedi here. So let me units. Good. So therefore, you have what? 250 units, right? You get 250 units. Good. Great. That is why in the operating statement that we prepared, when they produced 250, the profit was what? 0. So that's why we don't need to do more workings. I mean, we did 3, right? We did at 200, at 250, at 350. In fact, the truth matter is that I already solved the question before setting it. So that's why it was 9. But if I should ask you, I should put any figures then ask you to tell me the break even, you're going to use guesswork. You will guess and guess and guess and guess and guess and guess. If you're not getting 0, that's not the answer. So if you guess and then the final answer is not 0, that means that's not what you're looking for. So that's why there's the need for these formulas. So these formulas will help us to now do the calculation a bit faster. So that is it. So that's 250 units. Great. 250 units. Now, what will be the break-even sales value? Break-even what? Sales value. So what will be the break-even sales value? Great. That one, you just have to pick the break-even unit of 250 units times the selling price of what? 12. And we had what? 3,000, right? So it's 3,000 cities. And then you are done. So that's the first formula, or the first set. Formula 1, break-even point. So, and I read these are the 2 issues. Yes, I like that. That's 3,000. Great. So kindly get the first formula down and then we continue the game. Good. Break even at what? Target profit. So that's the next one. Break even at target profit. So that's the formula number 2. Formula number what? 2. Break even at target profit. Break even at what? Target profit. So break even at target profit. So formula number 2, break even. In fact, let me write the full name or the actual name. We call it unit to be produced or unit required to earn a required margin or profit. So unit required or to be produced or required. So unit to be produced or required. Unit to be produced or required. Okay. Unit to be produced to earn to earn a required, the word required margin. Alternative will be target profit. Target profit. I like that. The profit. If your eye is on certain amount of profits, then you factor it into your calculation. So if you want to make a profit of 20,000 Ghana cedis, so the question is, what will be the unit that we have to produce in order to make a profit of what? 20,000 Ghana cedis. That is what we are going to look at for. Great. Assuming that you want to achieve certain amount of profit, what will be the units? So that's the unit to be produced in order to earn a required margin or target profit. So in short, we normally call it break even at what? Target profits. But this is a full picture. So the examiner will ask you the question that we solved, if you want to achieve a required margin or a target profit of, let's say, 2,000 cedis, what will be the production unit or the sales unit? So the formula will be like this. So the unit required is equal to, in fact, fixed cost, add whatever profit you are looking for, add it to it. That's all. Add the profit that you're looking for, the target profit, so TP, target profits, all divided by the contribution per unit. How we get it? So add the target profit or the required margin or the required profit, add it to that of the fixed cost, and then divide it. You are done. It will tell you or to give you. So now let's see this for this question. They want to earn a required margin or a target profit of 2,000. So now let's see. Let's do substitution here. Good. So therefore, still our fixed cost is 1,000, right? Our fixed cost is 1,000. Agreed. So 1,000 plus the target profit of what? 2,000. All divided by what? The contribution per unit is what? 4 cedi. So what will be the units? And then that's the end. So yeah, it will be 3,000 divided by 4. And that'll give us 750. Good. So when they produce 750 units, that means they'll get a profit at what? Their profit will be 2,000. That is the interpretation. So that's the second formula. Today we are just going through the formulas. So today we are just going through the formulas so that when I start the actual game, you are fine. So today I'm looking at the formulas that need to be adhered to. Good. Now, this target profit, it must be a controllable profit. It must be a profit that the entity can control. So if there's any item which the entity goes beyond the control of the entity, it must be taken out. And the one that normally worry students with is the tax. So this profit, we assume that it is what? It is before tax. So if they give the profit, the target profit of uh, the target profit of 2,000. Now this profit of 2,000, whether there's tax, but once the examiner is silent about the tax issue, here we are assuming that it is what? Profit what? Before tax. Yes. But the profit before tax that you can what? Like control. The tax you cannot control because the tax you don't have much control over your tax issues. Good. But that one to be determined by the tax authorities, not yourself. So that is it. So what if one question I inform you specifically that this question or this profit is after tax? So to achieve profit after tax, that's antipart of let's say 2,800. So if they want to achieve a profit after tax of 2,800, how do you do? Meanwhile, we know that this profit, it must be before tax. Always, it must be before tax. When the question is silent, don't create issues for yourself. When the question is silent, like the first question that they didn't mention any tax inside, so we didn't even assume any tax, so we solve it like this. When they don't mention any tax, don't worry yourself. But when the examiner start mentioning tax in the question, then tell the examiner that the profit that we are looking for, it must be profit before tax, not after tax. So if they are giving you the profit after tax, what do? Gross it up to get what? The profit before tax. So they will give the tax rate. Let's assume that if the tax rate is, let's say, 20%, what is the profit before tax? Good. So kindly work it out for me. If the profit after tax is 2,800, the tax rate is 20%, what is the profit before tax? Before. That profit what? Before tax. Good. Now let's see how best we can work out this. Now, in fact, let's prepare a quick financial statement here. Very quick one. In fact, I'll let you solve it for me again. Yes. Let's prepare a quick financial statement here. Let's assume that you are calculating and you get a profit before tax of, let's say, 2,000 Ghana cedis. And then your tax is at a rate of what? 20%. So what will be the tax? 400, right? So what's the antipart? Profit after tax will be what? Profit after tax will be what? That's 1,600, right? That's the profit after tax. So the question is, if I inform you this figure with the help of this tax of 20%, how are you going to generate what? The profit before tax. How? So how? So it means that, in fact, have diverse ways to get, you call it gross it back, gross up. So we have to add a tax to it. So that means we need 100%, right? So this profit after tax part, it represents what percent? If the tax rate is 20%, then the net of profit, net of tax will be what? 80, right? So that means this profit is what? 80% of this figure. So the profit after tax is 80%. So therefore, the profit before tax is what? Is 100%. Always. Before, it must be 100. If I understand this issue, that's all. We're not solving the question. So therefore, let's do the analysis. So if 80%, this profit after tax is representing 80%, is now equal to 1,600. What are you looking for? I'm looking for the 100%. So therefore, 100% will be what? You don't know. Then you solve it. Exactly. Good. So that is one style. That is one style. That is one style. Good. Then, so let me use the shortcuts approach. So all what you have to do, the second style is pick the 100, what you're looking for is 100. Divide it by what you have, the 80. And then times what? 1,600. You are done. It will give you what? The 2,000. So 100 divided by 80 times the 1,600 will give you the 2,000. So you can confirm for me. Then alternative, you can also pick this profit after tax and just divide it by 1 minus the tax. 1 minus the tax rate. The tax rate is 20%. So to be 0.2, right? So therefore, 1 minus 0.2 give us what? 0.8. So therefore, 1,006 divided by what? 0.8. So it will also give you the 2,000. All of them will give you the same answer, and then you are done. So this is how we are going to, or we'll be going through to calculate the profits before tax. So that means the first one that we did, we have to revisit it again. Yes, we have to do what? Revisit it again. So the first one, you are doing for me. Yes. So we said that the profit after tax is what? 2,800. And then the tax rate is what? 20%. So what's the profit before tax? So now with the help of what we did just right now, calculate the profit before tax for this person for me. So you got it up. So that will be 100 divided by 80. Why 80? Because 100 minus the tax rate of 20. Good. So times what? 2,800. So therefore to give us what? 3,500. So that is it. And if you work back to, you get the same answer. Yeah. So the 3360 cannot be true, and then the 30802 cannot be true. So that is it. Good. So now that we know that the profit before tax is what? 3,500. We will come and then replace it here. So here will now be what? 3,500. It ends there. And then we solve the issue again. Good. So that is it. Yeah. So I'm done with the target profits or the required margin. So that's the formula what? 2. The formula 2. Formula 2. So that is it. So I hope you get it. So in short, when they give the profit after tax, try and convert it. Try and convert it before bringing it here. Or if you like to, we can put it in that if the profit given to you is after tax, then convert it by saying this. The profit after tax divided by what? 1 minus the tax rate. So this is how the formula will look like, and then you are done. And this is the grossing up. But if there's no tax in the question, then you don't need to worry about grossing up. Just pick whatever they give you and then use it. Then you are done. That is it. Okay. So now let's move on to the next formula. So the formula number three. Formula number three. Number three. Number three, and left with the last one. Then we are done with the formulas for the single product. So number three is the margin of safety. Margin of what? Safety. Wow. So that's the third one. Margin of safety. Margin of safety. So that's the formula number three. Margin of safety. Margin of safety. Margin of safety. Now, margin of safety. No, if you know that if you jump or if you stretch your leg for at least a distance of 50 meters, you fall into a gutter. So what do? So it means that you have to stretch or jump more than 50 meters, right? So that you won't fall. So let's assume that one time you jumped, let's say 75, distance recorded, in fact, 75 meters. So it means that the excess was what? 25, right? So you've allowed a safety of 25. Now let's bring it into the break even here. If you know that when you produce, this is a profit and this is a production unit. For our question, when you produce units 250, your profit is what? 0. You are not making any profits. That's when you produce 250 units. Let's assume that you are the production manager and you are budgeting for next period. What will be the unit that you are going to key it in? Are you going to budget for 250 or you budget for less? Or you budget for what? More than 250? So either you budget for less, the same, or less, more. So tell me what you will do. So if you are in the position of what? Production manager, what will be your decision? So are you going to budget for the 250 or you budget for more? Any idea? You budget for more, right? Good. So that at least, so let's assume that you prepare a budget. It's okay, me, I'll budget for 300. Because if you produce below the break even, you get loss. And then the critical example is what we did. When they produced 200, there was a loss. Good. So anytime you know the break even, it will help you to determine the budget. So you produce what? More than the 250, more than the break even, so that at least if there was production inefficiency, the margin of safety will save you. Good. So yeah, the safety that we have key it in is what? 50 units. So that's the margin of our safety. I want you to derive the formula for me. That's why I'm using this illustration. This is a break-even unit. Break-even unit. And now we know how to determine that one. This is the budgeted unit, budget, or budgeted level of activity. This is the budget. Good. So now tell me the formula for finding what? Margin of safety. Great. So in short, the margin of safety is nothing but the difference between the budgeted level of activity and the break-even level. So these two levels are what? They are different. Is what we mean by the margin of safety. Let me do it again. This is our profit. This is the unit. When we produce 250, our profit is 0. So for that reason, we call it break even. Break even units. So we budgeted to produce what? 300. So we call it budgeted units. 300 units. So we have allowed a safety because if you know that when you jump 250, you fall inside the gutter. What do? You have to add, like stretch your leg. So that's why, let me keep this story. Then, if you know that 250 will let you get no profit, meanwhile you are in to make money. So you budgeted in a way that, or you pay your budget in a way that there will be profits. Then it means you have to produce more than what? The break-even units. So that is the idea. Now let's go to the formulas for finding margin of safety. So basically, margin of safety is the difference between what? The budgeted unit. So that's budget minus what? The break-even, right? Then with 300 less what? 250. So that will give us 50. Oh, then we are done. That's what we mean by margin of safety in what? Unit. Just that there are so many types of margin of safety. We have 3 forms in which you can express the margin of safety. Let's look at it. And then that's the end of the game. Now, margin of safety. No shortcuts in essence. Margin of safety. One, you can express them in 3 folds or 3 ways. First, we have it in units. Second, we have it in value. Third, we have it as a percentage. As a what? Percentage. That is it. So as a percentage. So these are the 3 ways in which you can ask a margin of safety question. So in units, in all, the idea is that is the difference between what? Budgeted unit and what? The break-even unit. So unit is equal to the budgeted unit minus what? Break-even unit. What about the value? The value. So margin of safety in terms of value. That means the sales value. So here, let's look at this general formula. Anytime they're asking you value, total value of something, just have to multiply the per unit of that item by the selling, like the selling price per unit by the entire unit. So here too, it's equal to the selling price times what? The margin of safety in terms of what unit. How we get it? So the answer they are going to get here, just relax and multiply it by what? By the selling price. It will give you the margin of safety in terms of what? Units.
The margin of safety represents the budgeted
The margin of safety unit.
represents the budgeted.
Great. Even though you can also state it like this, or margin of safety unit is equal to budgeted sales revenue or sales value. Budgeted what? Sales value minus what? Break even sales value. How we get it? So that's the margin of what? Safety. Because the word margin of safety is the difference between budget and then what? The break even. So that's the alternative formula. All of them will give you the same answer. Now let's assume that this company, their budgeted sales unit is 4,000. Their budgeted sales unit is 400. Budgeted sales unit is what? 400. Calculate the margin of safety as in terms of unit value and as a percentage. For percentage, is equal to, for percentage is equal to, in fact, the budgeted unit less the break-even unit all divided by budgeted unit. So basically, I can turn the formula down. We know that the top one, just the top one alone, we know that just the top one alone is the same as the budgeted, sorry, the break margin of safety in terms of units. Because say as a percentage, just relax. Pick the budgeted unit, less the break-even unit. This the top one alone is the same as what? The margin of safety in terms of what units. Then divided by the budgeted unit times what? 100. Good. So in short, I can tell the examiner that margin of safety as a percentage is nothing by the margin of safety in terms of units, all divided by what? The budgeted units times 100 because of the percentage. Times 100. Good. So that is the formula. You can also use the value and then you are done. So the question is, if, from the question that we solve, if the budgeted unit is 400, what is the, calculate the following: margin of safety in terms of units, value, and as percentage. Start work. So our example that we are solving, if the budgeted unit is what? Let me write it full. If the budgeted unit is 400, calculate the margin of safety in terms of what? Units, value, and as a percentage. Start. Great. Yes. And then that's the end of this edition. Great. Let it together. That will be fine. Okay, so to get the budgeted units, it's our own question. The examiner is saying that we should assume the budgeted unit to be 400. So therefore, margin of safety in terms of units is the difference in terms of these two units, right? Okay, great. In fact, you're using these illustrations, these figures, where the selling price was 12 cities, variable cost is 8 cities, contribution was 4 cities, fixed cost is what? 1,000. So therefore, the break-even unit was what? That's the 250, right? So the break-even unit was 250. So that was the one that we are looking for. So therefore, the budgeted unit is 400. Break-even unit is what? 250. How we get it? So I'm just budgeted unit less the break-even unit. And here the break-even unit is 250, budgeted unit is what? 400. You are done. So therefore, it's equal to 150, right? So that's the margin of the safety or margin of safety that we have provided. And we said that margin of safety is nothing but the selling price times what? So in terms of the value, just multiply this figure by the selling price. Great. So to be selling price of 12 cities times what? 150. And that will give us Ghana city of what? 1,008, right? Good. That's correct. Then we come to the last one. As a percentage. Don't even worry yourself. As a percentage. Don't worry yourself to go this long formula. Use the shortcut one as a percentage. Is equal to the margin of safety in terms of unit divided by what? The budgeted unit. That's all. Times 100 divided by the budgeted unit times 100. Then you are done. So here the margin of safety in terms of unit is what? 150. 150 divided by what? 400, right? Times what? 100. And now God will give us 37.5%. That's the margin of safety. How big is it? Great. So this is how we're going to do together or to calculate the margin of safety. Good. So that is it. Now, first, let me add one last, if I have some 2 minutes. Let me add last formula number 3, so number 4. Formula number 4. We call it CS ratio, contribution to sales ratio. In fact, it's very important. So take note. CS ratio, contribution to sales ratio. So that's the last aspect. Then we are done. I'll not talk plenty, but I'll continue from that section next week. And then you are fine. Okay. So formula number 4. Formula number 4. Formula number 4 is contribution to sales ratio. Contribution to sales ratio. To sales ratio. In fact, we also call it CS ratio. CS what? Ratio. So if it's like this, then it will be C over S, right? That's all. We are done. C is the contribution, S is the sales. So contribution to sales ratio is nothing by, it's equal to either is the contribution divided by what? Sales times 100. It's really the contribution per unit alone. No. So that's all. You can Do it per unit per unit. So you can have a total contribution divided by total sales, or contribution per unit divided by the selling price divided by what? Selling price times 100. So either you go by total approach or per unit method. I don't do scatter and then like browse house things in both. Like here is total, here is per unit. No, don't do that. Or here is total sales and here is per unit. No, don't do that. Good, so that is it. So for instance, the first our illustration that we are doing, almighty illustration. By the time we finish it, will be a complete question. So for that one is the per unit basis. So we will have CS ratios nothing by contribution per unit divided by the selling price or sales. So divided by the selling price. Okay. So now what's the contribution? We have four series, right? Selling price was 12 times what? 100. It was the contribution. Sales ratio. The CS ratio will be 33. So that's 33.1%, right? That's the CS ratio. Or the 33.33%. Agree. So that's the end of the game. So let me give a trial work. Please, the works, ideally we should not compile them because as and when we are moving to be intense. Like for instance, today I'll try as much as possible to give more. Now we are done with the first aspect of the break-even. What level is question solving? Good. So our first illustration, here I'll not give plenty, I'll just give one. That's all. I'll give one for today. So you're just solving question 2 and question 3. Hey, 2 and 3, I thought I'll give one, but I'm giving 2. That's my one, no. Good. For question 1, that one is yours in advance, that one is theory. So we can just beside it, read through and you find. But all the formulas I provide them, you have the formulas down, and then you are fine. So question number 2 and question 3, you are doing that one for me. That's all. I'll not give plenty. Because I realize that if I give plenty, that I'm wasting the case. If I give it plenty, I'm wasting the case. So I have to give it more so that at least check on that. Great. So that's great. So thank you very much for coming or doing the listening or the watching. That notes, this is how far I've been the class to a successful end. Good.